Hi, welcome to InvestPro. My name is Rain, and today we're going to be talking something important and exciting because we're going to be learning about how to give us as a traders an edge to trade more profitable and more consistent in the stock markets. And by the way, if you have been trading for quite some time in the market, you probably know that trading is not easy, something very, very difficult. And especially when we are just about to buy the stock and then the stock start to go down. And then the moment we're selling it off, the stock prices soar higher. It's getting higher and higher. And as a traders, we many times ask ourselves, what's wrong with the approach that we have? Is the timing wrong or whatever? And because of that, a lot of traders, they argue the debate of what kind of the best approaches to be more profitable in the stock markets. Therefore, there are two major trading approaches. First is buying low, selling high. Well, certain traders believe that when the price is low, well, it is undervalued, so you want to get it right away because the moment you buy it, the price starts to go high, and the moment when it is high, it's kind of overvalued and you want to sell it off. So that's how you profit from the stock markets. The other one, they believe that, well, stock does not move in that manner. So you want to follow the trend. It's kind of like momentum traders because they start to believe the moment you buy stock, it starts to rally, well, the sentiment kicks in, then the stock is getting higher and higher. So in this episode, we're going to learn about which of these two approaches will give you a better edge as a traders. Now, do take note that I wouldn't say one is better than the other one because that really depends on the timing, depends on your capital, on your risk-reward preference, and there are various factors to determine your success in trading. But I want to emphasize that if you don't have any strategy, just simply buy and sell, which one of these two approaches is going to be giving you a better edge for you to buy and sell to be more profitable. And without further ado, let's get started. Welcome back to the InvestPro. If you are a trader, you want to learn about how to trade or how to possibly to profit consistently from the stock markets, I would say that you are just in the right channel. But before that, if you haven't subscribed, you haven't clicked any notifications, you want to do it now. Let's move on. So in order for us to understand which approach is going to be giving us a better edge, I did an experiment. In this experiment, I would like to learn about how these S&P 500 stocks or the biggest 500 companies in the US behave within a short-term period like 15 to 30 days time. And to understand them better, I use a proprietary indicators. I call it a moving price relative. And you don't have to Google it or looking for reference because like I mentioned that this is my proprietary indicator, moving price relative. Why this indicator is so powerful? Because it's going to help you as a trader to evaluate whether the price is low or high relative to its historical prices. And to do that, it's going to be very simple. This indicator is taking separators. They try to divide your chart into several layers or several levels based on their percentile. So the lowest point, I would say from 0 to 10%, that's going to be the lowest range. And then next to 10 to 20%, 20 to 30%, and so on until 80 to 90%, and the maximum range going to be 90 to 100%. So 100% is going to be the highest point. So with that, as a trader, you're going to be very easy to label whether your stock is low or high. Now, let's take a look at this chart. When you're assessing the last end day price here, I would say very clear, very obvious that it is located somewhere at the very, very low because simply located between 0 to 10% range or percentile relative to its historical price of 200 days back. And on this next page, you can see and you can tell easily that the end day price is relatively, well, at the high price or relatively high because simply it is located between 80 to 90% relative to 200 days back. So, well, as you can see that by using the moving price relative indicators, you can tell easily whether the price is low or is high. Now, do note that relative position of being high or being low also keep changing as and when you change the length of the historical price as your reference. Now, take a look at this next example. Now take a look, when I change to 100 days as our reference, I would say that the position of the end days now in relative is getting lower because it's getting closer to the line of the 80 percentile here. When I change to 50 days as our reference, then the end days, the relative positions is getting lower. I would say that right now it stays in between 70 to 80%. Once you have evaluated the price, be it at low or at high, then you like to backtrack for each bar or each day relative to its historical prices, backtrack it many years back as long as you can, because the longer you have of the data, more information, then your experiment's going to be or tend to be less biased. If you look at the point A, the price stays between the range of 70 to 80%. Now, if you look at the point B here, the price is staying at the highest percentile. It's ranging between 90 to 100%. And if you look at point C, well, I would say it stays low because simply it's the position stays between 0 to 10%. So A, well, relatively high, B, I would say pretty high, C, I would say it's at a low level. Then what we do next is that we start to group those prices together based on their percentile level. So for example, for those stays between 0 to 10%, then we will group them into the first percentile, and then who stays at the 20 to 30%, same thing, we're going to be group them into the second percentile, and so on till the highest between 90 to 100%, then we group them together at the highest percentile. And for this experiment, because we are doing it for 14 years back, so we pretty much having 1,764,000 of data analysis. Imagine within 1 year, there are about 252 trading days. And within 14 years, there are about 3,528 trading days. And this only apply for one stock. What about if there are 500 stocks? So altogether, we're talking about 1.7 million data. After grouping, or after we group them based on their percentile level, then we would like to observe further on how these prices move within a short term, like 15 days. We would like to learn more whether or not we can conclude on something after we separate or we segregate those prices based on their percentile level, be it low or high. What happened to those prices later within short-term periods like 15 days later? For the first experiment, we just used the 50 days moving price relative, which simply means that you're taking 50 days historical price to gauge or evaluate whether the price is low or high based on their percentile level. Now, when you take a look at the graph or the table or the chart here, it's pretty exciting that apparently those prices stays at the bottom between 0 to 10%. It gives you the highest return 15 days later, which is about 4.25%. And then when it goes higher, meaning say that when the price is getting higher to the top, maybe I would say 90 to 100%, the return is about 1.36%. Well, you probably would like to understand about how we derive this number, how we derive the outcome. Well, this is simply that the number derived from the 500 stocks. Altogether, we take the average. So it is the same thing like your position holding 500 stocks, and some of them are performing positive and some of them performing negative, then you take the average, and that is how you get the result or the return. One exciting point that I would like to highlight here is that, well, while you learn that the bottom giving you the highest return about 4.25% and the highest point or the highest level between 90% to 100% gives you about 1.36%, but what about in between? And you can observe that those ranges or starting from second, third, fourth, and when it goes higher, you could see that the return is getting less and less. It's gradually declining, I would say. So this pattern, I would say, is a pretty strong pattern. I would say that it's really that when you picked up those prices slightly on a lower level, in general, it will give you a better edge in terms of the return or the outcome 15 days later. So that is how I just make one rough conclusions here. And we just would like to know how strong this behavior, let's say if we take another historical days as a reference. Now let's take a look. If we take 100 days moving price relative, means that we are taking 100 days as our historical price reference. Well, apparently it gives you the same result or the same behavior. Those prices stays at the bottom between 0 to 10%. It gives you the highest return for the next 15 days, and also the top, which is between 90 to 100%, give you the least returns, and in between, well, I would say that the higher the position or the price, then it tends to give you less return 15 days later. So this apparently this behavior is kind of similar with those 50 days reference moving price relative. What about if we are checking for 200 days and we would like to observe if this behavior is still the same? And yes, be it 50 days or 100 days or 200 days, they are simply behaving the same. So those prices that stay at the bottom between 0 to 10%, it gives you the highest return 15 days later. And those at the highest level between 90 to 100%, it gives you the least return 15 days later. And across this level, well, I would say that in conclusion or in summary, in general, that when the prices go higher, your returns gonna be becoming less and less, so it's giving you less edge in trading. So if you want to buy, I would say in general, well, those prices stays at the lower percentile tend to give you a better trading edge. Now these experiments, we did it for 15 days later. What about if we change the shift a little bit longer to 30 days later, and we would like to observe, is there any difference in its behavior on this edge, so we can conclude whether it is a strong pattern or not. So I just take those different days historical price of moving price relative table together, so it's going to be much easier for us to observe this pattern or behavior. Well, if you are observing the 30 days movement or 30 days later from 50 days moving price relative, well, I would say that those prices stays at the bottom between 0 to 10%. Well, for 50 days, it's giving about 3.23%. And when it goes higher, the return is going to be lower and lower. And at the top or at the highest level, 90 to 100%, it gives you about 1.7%. Well, this is, well, I give red color just to tell you, just for the color's sake, right? So it doesn't mean that it is giving you a negative return. Well, this is still a positive return. It is just 1.17%. So if you want to hold your stocks or whatever position for 30 days later, I would say the same behavior applies. As a traders, when you buy the price at the lower level, in general, it gives you a better edge, because I would say in average that it will give you higher return compared to those prices stay at the higher level. I would say the higher level will be less edge. The same thing for 100 days and 200 days moving price relative. You can see that for 100 days, the bottom give you about 3.72%, the top giving you 1.30%, and for 200 days, the bottom giving you 4.24%, and the highest point, or the highest level, 90 to 100%, give you about 1.37%, given if you hold the stock for 30 days later. Well, do you find the similarities of the behavior for those traders who want to hold their stocks for 15 days or 30 days? Apparently, based on the data, those prices or stocks that stays at the lowest position between 0 to 10% is giving the highest return or the highest edge compared to those stock or prices who stays relatively on the higher level or higher percentile. So be it 50 days, 100 days, or 200 days has historical price reference, and holding it for a short-term period like 15 or 30 days, I would say that the data shows a very strong behavior that those prices stay at the bottom or stays at the lower percentiles. In general, it gives you higher return or a better edge compared to those prices who stays at the higher level or at the higher price. So as a traders, without any given strategy or without any specific insight about the market or the stock itself, I would say that I will prefer buy low, sell high, because randomly or in general that it will give me a better edge rather than I buy high then sell higher. Remember that I would not say that one approach is better than the other one, because the success in trading, it counts many factors, including your risk reward preference, your timing, your ability to see certain thing in the markets, your strategy as well, your capitals that will count in. It is only that when I don't have a trading strategy, I just simply buy and sell. I would say that based on the data and the experiments that we do, apparently buy low, sell high in general is going to be giving us a better edge as a traders in terms of the returns. So hopefully that the data that I just shared with you is going to be very useful for you, and it help you to create or build your own trading strategy. But do remember that I never encourage you to do trading, because trading can be dangerous, especially if you don't have a proper money management. But just in case, if you just do a trading, you just buy or sell stocks, be it in a profit or be it in loss, hopefully that this data can give you some insight about a certain behavior, especially for S&P 500 stocks within a short-term period like 15 or 30 days time. So till then, I will see you in the next one.